Alrighty guys, what is going up? I hope you guys are all having a great and amazing day today. Now in today's episode, we're going to be talking about the difference between stocks and ETFs. Which one should you invest? Carter, I want to be a millionaire. Which one should I invest in? We're going to be breaking down everything in this video. So I hope you guys enjoy it, and overall, I hope you guys learn something. And if you guys get anything in value, it would really mean a lot if you guys smash the like button as hard as you can. It's free and I really appreciate it. So now let's jump into it. Roll the intro. Let's go. Bam! So now, what is a stock? When you guys go out and you buy a stock, you guys represent a small ownership in that company. So when you buy a share of Coca-Cola, you get the profits when they make a ton of money and the stock value goes up. And on the downside, if Coca-Cola starts losing money, you guys get the stock value going down. So it's all about doing research and making sure that you guys are choosing the right stock. Now, another thing, when a company makes so much money that they want to pay you, this is what they call a dividend. Now, stocks have a tendency to pay more in dividends than ETFs, which is great for investors, but you guys carry the risk of holding that stock. Now, what is an ETF? An ETF is also known as an exchange traded fund. So you might be saying, I don't know what that means, Carter. Well, it's very simple. The company behind the ETF will go out and they will buy a ton of shares of certain companies. Then they will offer those shares in the form of ETFs and holdings. So if you guys want to invest in the top 500 companies out there, it would cost you guys thousands, if not hundreds of thousands of dollars to go out and individually pick the top 500 companies out there. But there's a ton of companies that have an ETF that just tracks the S&P 500. So all you guys have to pay for is the ETF price and the expense ratio. The expense ratio is really what that company charges to manage all of those funds. Most of the time, ETF charges under 1%. If they charge over 1%, don't buy into that ETF. It's way too high in that overall expense ratio. Now, why people buy stocks over ETFs? Well, one, they may be very, very strong believers in that company, which is awesome, but you guys have to understand is that stocks carry more risk, but often have more reward. Now, when choosing a stock, it's always up to you, the investor, to go out and do your own research. Now, I would recommend looking at stuff like this: long-term debt, cash on hand, EPS, also known as earnings per share, price to earnings, and future predictions of that company. Also, you guys want to check out competitors. The reason why is because you want to make sure, you want to see what the competitors are doing that may hurt that business. Also, stocks have a tendency to pay more in dividends. Look at AT&T, that pays around a 7% dividend, as the S&P 500 ETF pays around a 3% dividend. So you guys can see that investing in a stock may have more reward, but it carries more risk. Now, why do people buy ETFs? People buy ETFs because it's a very, very easy way to get access to the whole market. If you went out and you bought ticker symbol VOO, this is Vanguard's S&P 500 ETF. So really the downside of this is the overall expense ratio. The expense ratio for this is 0.04%, which is extremely low, and this is one of the best ETFs that I would highly recommend. Now, the stocks in this holding are the top 500 companies available for the public to buy. Yes, it does pay around a 3% dividend, which is actually pretty solid for an ETF. Also, the S&P 500 on annual has around a 10 to about 12% annual growth, which is actually really, really strong. And a lot of people use and invest in ETFs for retirement and very, very long-term growth. So now let's go ahead and look at Apple versus the S&P 500. So a lot of people think there's more opportunity when you guys invest in Apple, which I definitely see that because Apple is the largest company in the United States. It has a market cap larger than Mexico, Canada, and a lot of European countries, because the market cap for Apple is $2 trillion. But when an investor looks at that, you always have to look at, well, if I want to double my money, that means Apple is going to have to go to $4 trillion market cap. And a lot of investors would say, okay, well, I would rather diversify my money because the probability of that growing so much and so fast is kind of low, but Apple is out out there. So with Apple, it does carry more risk, and with an ETF, it carries less risk. Also in 2019, Apple had around an 86% return, and the S&P 500 had around a 28% return. Both are actually really well, and that's super surprising, but you guys can see that Apple, more risk, more reward, and the S&P 500, less risk, less reward. Also, with Apple, you get paid a 1% dividend, and with the S&P 500, you get paid a 3% dividend. So honestly, that's actually very surprising because most value stocks pay more than a 3% dividend. Now, really the last and final thing, when you guys invest in an ETF, you get diversified. That's the biggest thing for investors to do. That's why they charge that expense ratio, is because they are the ones that went out and bought all those stock and really are charging you guys to have access to them. But overall, I think it's smart to have both. Here's the overall breakdown on how I invest. Really, I take around 20% of my money and automatically invest it in bonds. Now, the reason why I invest it in bonds is because they get around a 3.5% dividend and around a 5% growth per year, which is pretty solid. And then when stocks fall undervalued, I go ahead and cut back on my bonds and I invest into those companies. Now I take around 40% of my money and invest it into the S&P 500 ETF. This is that ETF that really just tracks the top 500 companies that get paid around a 3% dividend, and it grows around 10 to 12%. Now, with the last percentage of my money, I go out and I buy high quality growth and dividend stocks. I look for stocks that, in my personal opinion, I think are going to grow in the next 15, 20 years. These stocks are companies like Apple, Microsoft, Tesla, NEO, a ton of other ones. Now, it's all about balance when you guys invest, balancing your portfolio to really maximize reward and lower risk. So really, that is the main difference between stocks and ETFs. I really hope you guys learned something in this episode. And if you guys did, make sure you guys smash the like button. Go ahead, you guys can sign up with M1 Finance to get a free $10 towards investing. That will be the first link down below, so make sure you guys check them out. So now, we'll see you guys tomorrow. Roll the outro. Take care. Bam!